Good morning, ladies and gentlemen. Welcome to this morning's webinar, HVS's webinar, or this afternoon's webinar, which aims to explore the question of how has COVID-19 impacted on hotel values. My name is Chris Shepherdson. I'm the founder of EP Business and Hospitality, and we're very proud to be supporting our good friends at HVS in hosting today's webinars. It's become almost a cliche to say that we're living in the most interesting times, but it has certainly been full of unexpected twists and turns. The challenge today facing city centres is immense as they look to recover. The challenge facing hospitality is no less immense, and actually just seems to be getting that little bit more difficult as we recover all the time. In the UK alone, we have inflation rates that are rising between, presently being estimated to rise between 14 and 18%. Because the unique issues presenting themselves include a 50% increase in energy costs, 6 to 7% rise in food inflation, a shortage of talent which is estimated to leave us with 188,000 vacancies at any one time, which means in turn that lower end wages need to rise by between 25 to 30%, at least in the short term. This all impacts on the P&L, as you can imagine. However, as challenging as these all sound, actually there's some very good grounds for optimism and for the recovery that we're beginning to see. 2021 has seen a rise in investment activity across the global hotel sector, and there are many companies now beginning to be far more aggressive in their acquisition strategies as they look towards 2022. This seems to be particularly true in Asia Pacific, North America, and Europe. But do you agree with this? What will our experts tell us in a few moments' time? In addition, investor sentiment suggests that full-service hotels will endure the deepest discounts, and select service and economy hotels were less impacted by the pandemic and were still able to fill rooms. In fact, many believe that the best opportunities, investment-wise, to emerge over the next 6 months will be for full-service hotels. Again, do you agree? However, it is still estimated there's going to be 2 to 3 years before we see full recovery to 2019 levels. And many investors in that time will want to assess alternative models and approaches. How will this create change across the hotel sector? What new services and improvement measures for profitability will emerge? How will labor models change? How will the increased demand for greater sustainability impact on cost and investment? There's already all kinds of debates arguing that some of the costs we're seeing is because we moved to much more green strategies. Is that true? How will digital and transformation and improvements impact on services and engagement? These are all questions yet to be understood and explained. So we look forward to listening to our speakers today. EP is delighted to be working closely with HVS. They've become very good friends over the last couple of years, and we've hosted a number of events together. EP hosts on average 70 events per year and publish over 500 articles, as our aim is to bring industry together and share knowledge, explore new ideas and original thinking. As a result, we work with boards across all sectors, looking at business trends, consumer trends and strategies, and also look at collaborations and initiatives which can bring companies together to find new answers. Our core belief and philosophy is that we're stronger working together. Our role is to try and create new frameworks to allow that to happen. As a result, we're delighted to obviously be co-hosting today's event, because actually this is a great example of real experts sharing knowledge with you. So I really do hope you enjoy today, and I'm sure you will. I'm sure we're going to find it the most fascinating time. May I now proudly introduce you to Russell Kett, Chairman of HVS. Russell.
Good morning and good evening and good afternoon, wherever you are in the world. Thank you, Chris. And on behalf of HVS, welcome to the first of 3 webinars which we're hosting today. I want to share my screen briefly, if I may, and hopefully give you an idea of what's in store. I will say that we are packed in this agenda. Everybody is working under an unrealistically tight timescale, and I apologize if, as a result of that, some things aren't covered in as much detail as you would have liked. We will be making the slides available afterwards, as well as a recording of this session, if you want to experience it again in your own time. But after I've finished this introduction, I'm going to hand over to my esteemed colleague, Hock Yan Chi from the Asia Pacific region, who will then take us through some key changes in hotel values in Asia Pacific, followed by Mandeep Lambda from India, Charles Human on Europe, Halamata Shufani for Middle East and Africa, and Rod Clough on the Americas. Before then, Jens Busch will talk about the impact on people and talent, and then we'll all convene for a panel discussion to answer the questions, some of which that I have prepared, but most importantly, our delegates, I encourage you to send us your questions using the Q&A function that you'll find at the bottom of your screen. Please don't be anonymous, and any questions that we can't get to during the Q&A session, we will undertake to get back to you with answers afterwards. So without further ado, my pleasure to invite Hock Yan Chi to present to us on Asia Pacific. Over to you, Hock.
Thank you, Russell. Good afternoon, everyone, and good evening to some of the other people tuning in, as well as good morning to some. Well, today we're going to bring you through some of the key changes in hotel values in Asia Pacific. I'll be covering Asia Pacific, and after me, Mandeep will cover India. So onto the next slide, if we can. Well, you can see from this, actually, we sourced this from STR. Thank you, STR. But the forecasts are what we do, the HVS forecast. So as you can see from here, actually, during the financial crisis in 2008-09, there's a drastic fall, right? It's 19.8%, say give and take about 20%. And then it went up in 2010, 11. But since then, the RevPAR has actually been falling. Occupancies, you can see the gray line is more or less the same, give and take 70% plus minus. But it is actually the ADR that has been declining over the years. And due to the COVID, you will see that in 2020, there is a decline of almost 50% in RevPAR from 2019. And year to date, the numbers that we have year to date, 2020, it was the lowest point. Occupancy actually came down to about 40%, and RevPAR, really crashed through the roof. So basically, if you look at now, year to date, August 2021, it is gone up. Occupancies have crept up, not quite 50%, but the RevPAR has gone up because ADR has gone up. So we are seeing a moderate recovery in 2020, and year to date, it's actually better than year to date 2020. Next slide, please. We looked at the fastest and the slowest growing top markets in Asia. You can see on the slide, actually, the countries in North Asia are really doing well. We have Beijing, Sanya, Shanghai, Hong Kong, and Seoul being in the fastest RevPAR growth. Like Beijing is 100%, Sanya is 90%, Shanghai is 80%. And conversely, the slowest RevPAR growth is really in Southeast Asia, Phuket, Thailand, Bali, Indonesia. And you will note that these are actually the resort markets: Bangkok, Thailand, Kuala Lumpur, Malaysia, and Osaka, Japan. So we had a look at this, and actually when we consider the fastest RevPAR growth, there are a few key cities that actually enjoyed positive occupancy and positive ADR growth, and that is actually I just named a couple of cities: Beijing, Shanghai, and Seoul, which you can see here they are the fastest. And in terms of, there are some markets like Singapore, maybe Melbourne, the Maldives, where it could be a case of either occupancy growth or ADR growth. And for Thailand, Phuket, Bali, all these are actually both a decline in occupancy and a decline in ADR. Just a little on the vaccination. As at end of September 2021, this is Asia Pacific. So 66% of Asia Pacific has more than 50% of their people vaccinated. However, in this instance, compared to the Americas, we are quite far behind. We are kind of like maybe, yeah, it says 50%, but Americas is already in the 60%, and Europe is also higher at closer to 60%. And actually, in the 3Q of 2021, we noted that there has been spike in a number of the Asia Pacific, the spike in the COVID numbers in a number of the Asia Pacific countries, hence leading to quite a number of restrictions that have come in place again in 3Q of 2021. Next slide, please. Okay, onto transactions volume. Transactions volume really fell by 42% in 2020, where it's the COVID year. The number of transactions have fallen, as well as the number of the volume of transactions. You can see the number of transactions in North Asia, Australia, and New Zealand, and Southeast Asia, which also we have included Maldives here. The numbers have dropped from 2018 down to 2019 and 2020. And in terms of actual transaction volume as well. On to the next slide, you will see that the top 3 most active markets in Asia Pacific is actually Australia, China, and Thailand. With regards to Australia, we track from 4Q 2019 to 3Q 2020 to this year, right? There's 84 transactions in Australia. It is the most active market. And in terms of volume, right, it was from 0.76 billion to about 2.2 billion worth of transactions in Australia. China, you see about the same number of transactions, but the volume has actually gone up. And Thailand as well, you see from 4 to 10, and that's an increase in the number of transactions as well as volume. Now on to the next slide, I just highlighted a couple of notable transactions in 2020 and 2021, which is in the midst of COVID. And you see that they have all taken place, the high value ones in North Asia, typically in Tokyo, in Kyoto, in Seoul, and in Taipei. And the price per key, it is relatively high. You see in Tokyo, it's 5 million US. Kyoto itself is also very high, 3.7. And even in Taipei, Sunworld Dynasty is 1.2 million US a key. So despite COVID, transactions are happening and transaction value is high. Now on to our forecast for the values. Here you will see the slide that what we have done is the index slide. We reference 2019 to an index of 1, and you'll find that this is the value has actually declined, of course, from 2019 due to the steep decline in the RevPAR. And actually, if you look at the curve here, Australia and Oceania has somewhat bottomed out and actually is on the rising trend. Likewise, for Northeastern Asia, Whereas Southeast Asia is still on the decline, and we are kind of like bottoming out in year 2021. And looking forward 2022, it's on a slight uplift. And if you look at this, we are anticipating that values would probably go back up to pre-COVID level of 2019 from year 2023 onwards, depending on which region you will be at. Thank you very much. On to Mandeep.
Hi, everyone. Thank you very much for logging in from various parts of the world. We're delighted to be hosting this seminar today, and we hope that we can add some value to what you were looking for in the first place when you came to attend this webinar. I'm going to quickly run through India. We saw a drastic fall of almost 57% in RevPAR due to the impact of COVID, the highest that we've ever seen. The earlier drop was 16% during the 2008-2009 period. This has been devastating for the industry, as it has been globally. Slow recovery in occupancy. We slipped to 33% in 2020. We're up about 10 percentage points to around 42% currently, YTD. No significant change in the RevPAR levels between last year and this year. Current YTD revenues are about 45% of what we were pre-COVID. So revenues are about anywhere between 45 to 50% of where we were before the pandemic hit us. It's the leisure sector leading the recovery, as we've seen globally. And in the city markets, it's more of staycation and vacations. That has been the new market, which is rescuing the industry, so to say. Some of the markets which are doing well or sort of picking up better than the others, fastest RevPAR growth we're seeing in Chandigarh, in Goa, Kolkata, Chennai, and Jaipur. Chandigarh is largely because of social functions. Goa has now become the leisure capital of India. Everybody seems to be heading to Goa. Jaipur is again a leisure market, leisure market, which is caught up close to Delhi. A lot of staycations happening there and vacations as well. The similar story with Kolkata and Chennai. And we've seen a drop in RevPAR in key cities of Bangalore, Mumbai, New Delhi, Pune, and Hyderabad. Bangalore, Pune, and Hyderabad very significantly because of the IT markets. These are the sort of IT hubs in India. And because most of the IT companies are still working from home and there've been no return to office yet, gradually happening. We're expecting that to happen towards the end of the year. So those markets have been more impacted in terms of their performance than the others. India's done very well on the vaccination front. We started a little late, but we've actually had more than 1 billion vaccinations administered, which is more than the vaccination in any part of the world in terms of numbers. Of course, we have a very significant population. So in terms of the total population getting fully vaccinated, we're still at around 30%. But 70% of our eligible population has now received at least one dose. And currently, as we speak, India seems to be managing the COVID situation rather well. We don't have any serious issues of outbreak. We're still grappling with it. We're still dealing with it. But it's looking as though things are gradually returning to normal. We're just a little concerned about the festive season that is now unfolding on us. And if we can see this through, I think that the recovery on the hotels front will be far more rapid than we've seen in the past. Transaction values have declined, just like Hawk said earlier. In India, we saw in 2020 transaction values declined by almost 50%, from 700 million in 2019 to about 350 million in 2020. But unlike mature markets, India doesn't see too many transactions, and it defies the general sort of trend that you would see in transactions when there is so much distress. In mature markets, you'd see a lot of trading happening on assets. In this kind of environment, you'd see a lot of lenders reaching out, to sell assets. A lot of investors looking at buying assets. Strangely, this is India. We haven't seen a single transaction of any significance take place so far in the calendar year of 2021. There continues to be stress on those assets which are highly leveraged. And we anticipate that there will be a growth in the transaction volume in the next year and the subsequent years to catch up with the sort of quiet that we see at this moment in time. These are just some of the notable transactions which took place. You'll see that post-COVID, there actually has been just 2 transactions. Out of which, the Ritz-Carlton in Worli, Mumbai was not seriously a transaction. It was more one shareholder buying, the stake of another shareholder in the same company. And the other, of course, was one hotel, the Aloft, which traded at about $29 million post-COVID. And that's the sort of rather minuscule amount of transactions that we've seen post-COVID. On the value index, we think that the values have dropped by around 30% between last year and now. We think that the values will recover, and by 2023, by around the middle of 2023, we think that values should come back to pre-COVID levels, and then we think that there will be a growth in the values going forward from 2023. Thank you very much, ladies and gentlemen.
Hi, everyone. Greetings from London. Quick 2 minutes on Europe, where the news is increasingly positive. I think it's fair to say that the recovery is now well underway and gaining momentum in some markets that exceed expectations from even only a few months ago. So this chart shows the RevPAR trend this year to date compared to last year. It's an exact mirror image reflecting lockdowns and travel restrictions in Europe mid and latter part of last year, and then again this year, and opening up in the summer. We've seen a leisure-led recovery as in other parts of the world, with regional national markets picking up ahead of gateway cities, and in some regional cities remarkably strong performance now, and gaining, as I say, gaining impressive momentum. In the gateways are now starting to see an uptick. Paris, notably, I was there last week, very busy feel to it. Markets now at 50% occupancy in September, and holding rate strongly, driven by events, leisure business, and small meetings. London, again, there was concern about the market. It recorded 60% occupancy in September, much busier feel. Rate has been impacted, but it is gaining momentum, gaining well. Other markets in Europe, and this is just a selection, but other markets, Amsterdam, Prague, are leisure-driven markets, but have lagged the recovery, partly because of stronger local restrictions on travel, but also because of the reliance on US visitation, which has been restricted until now, and dependence on the MICE market, which is obviously also still lagging. Next slide. So we're forecasting that RevPAR, that occupancy will be up 10% this year at the year end on last year, and rate up 6%, with the recovery gaining momentum through next year. So we're forecasting market-wide, obviously difficult to forecast on a totally Europe-wide basis, but we're saying that occupancy will rise to 61% market-wide next year, with rate growth of 9%, followed by another 9% percentage points increase in occupancy to 70% in 2023, and 10% further ADR growth, so taking us in 2023 back to 2019 levels. On the value front, the good news there is that the value decline has bottomed out. We felt that values had bottomed out around about the start of this year, and the decline was not as great as many were fearing and predicting. So based on our valuations and our transaction experience, we've seen value declines in the range of 5 to 15% lower. Obviously, there are outliers at both ends to that. We're seeing value growth. We're already seeing value growth this year, so we're through the bottom, and we're generally predicting that values will recover to 2019 levels by the end of 2023, and frankly could be sooner, given the pace of recovery of demand. There are headwinds out there. There are some wild cards. There's clearly cost pressure, which is hurting margins, and we could start to see interest rate increases in the UK, at least in the near term. Transaction market is still slow, but it's picking up. So year to date, transaction volume is just over 8 billion euros compared to just over 6 billion same period last year. There's more in the pipeline, so we are expecting to see quite significant growth in transaction volume as at this year end compared to last year. An obvious trend within that is the increase in investment into leisure markets, particularly the Southern European resort markets, which is led by increased investor interest in that type of hotel, but also less value decline in resort hotels. We are generally seeing an uptick in the number of properties being brought to market. We're seeing an uptick in inquiries from owners wanting to sell and take advantage of the fact that there's a huge amount of capital out there looking to invest, very little product for sale, and for the right type of asset, a good time to hit the market. Here's a selection of transactions that have taken place this year. The most significant is Henderson Park's recent acquisition of a portfolio of 12 Hiltons in the UK for over £500 million. A number of important transactions in Southern Europe, including a couple that we handled, such as the Edition Madrid, which we sold, and for TUI, their 1,000-hectare Castelfalfi resort in Tuscany. Not much activity in London. One transaction was the Park Lane Mews, which was bought by Bain Capital earlier this year.
Good morning and good afternoon, everyone. Thanks for joining. The Middle East region has observed similar downward trend in travel and RevPAR as compared to the rest of the globe. But for the purpose of this presentation, we have broken down the GCC from the Middle East, as well as looked at breaking down Africa into sub-regions because of different demand characteristics, as well as recovery timelines. We are definitely seeing recovery growth in the GCC, with some markets clearly performing better than others. We're looking at Dubai, that has improved quite drastically in the last 12 months, especially as they opened their airport in July 2020 and were able to capitalize on both domestic regional demand, but also international demand. When considering the corporate markets, Riyadh and Doha, they benefit from a healthy base of corporate demand, whether in Doha with the lead up to the World Cup in 2022, but also in Riyadh on the back of local demand, but more so to support the Vision 2030. What has been interesting also to note in KSA specifically, that despite the pandemic and the travel restrictions, that hotel developments and hotel schemes, which are quite large, are well underway, whether in design or even in terms of execution. On the other hand, when we look at Africa, with the exception of Egypt, specifically Cairo and Seychelles, both benefiting, Egypt on one hand from very strong domestic demand and Seychelles from international visitation, clearly low infection rates, and a very well management of the pandemic, we have seen across Africa a slower recovery than elsewhere, and probably more so into 22 when we're going to observe a better recovery for the remaining African cities. This will clearly be very much contingent on the vaccine availability, as well as the rollout of the vaccine, and more importantly, on travel connectivity. What I would like to highlight in terms of RevPAR growth, specifically for the GCC region, we have observed a downward trend since the 2015 into 2019. This was a result of an aggressive pipeline of new hotels that have entered the market, especially in the UAE and Qatar, to a less extent in KSA, but more importantly, the entry of mid-scale and budget hotels. So when looking at forecasting recovery for the GCC in particular, we do not expect a significant improvement in RevPAR beyond the 2019 levels. There continues to be quite an aggressive pipeline, more so in the Kingdom of Saudi Arabia, and perhaps to a lesser extent now in the UAE, as well as Doha. On the other hand, and subject clearly to improved travel connectivity into Africa, as well as the rollout of the vaccine, we do anticipate that most of the African cities will recover significantly beyond the 2019 levels. And this was clearly visible in the RevPAR performance for the African cities between 2017 and 2019. When looking at value recovery on the next slide and the impact on values, similar to the other regions across the globe, the Middle East average has dropped by roughly 18% when considering all 20 markets that were considered. In absolute terms, this is just sitting under $200,000 in 2019 values. We are certainly expecting recovery on the back of improved RevPARs in Africa, not so much for the Middle East, but what we have observed also in terms of managing the operations is the reduction in costs and more efficiencies, which has clearly impacted positively the bottom line. Keeping in mind that, again, when we look at value transactions in the GCC, specifically between 2015 and 2018, we have seen a 30% drop in values because EBITDA levels have declined as a result of rising costs by 5 to 6 percentage points. That was the correction that was anticipated in this market. And therefore, while we do forecast that in particular Riyadh and Doha would exceed the average by far in 2025, that most other markets will grow slightly and recover beyond the 2019 levels, with the exception of some markets such as Kuwait and Manama that don't necessarily have any key developments or demand generators. Unfortunately, in our part of the world, despite the hope that the transaction market would take place, there has been very limited transaction to mention. A key transaction in the UAE was the address portfolio, which took place in 2018 and again in 2020, averaging around $450,000 a key. In Africa, there were a couple of transactions at an undisclosed price. However, we understand that these were also acquired at a very low price point because they require major renovation. So this really raises the question as to, with those some distressed assets and investor appetite, especially in the GCC, how come there aren't enough transactions or notable transactions in this market? On that note, I'd like to thank you and I'll pass it on to Rod.
All right, our look at the Americas begins in the US. You can see that we had a rather drastic decline in RevPAR of about 50%. And the recovery has accelerated this year, particularly with the release of the vaccines and people getting back out and traveling. You can see in the gray bar that occupancy has bounced back from where we were this time last year at 45% to 58%. We still have about 10 points to go. We were at 68% this time in 2019. Average rate has come back by about 15%. And same with average rate. We have about $10 to go to get back to normal. Year to date, we're at $122, and we were at $132 back this time in 2019. You can see on our next slide that we project RevPAR to recover by 2024. We're at $89 then, having been at $87 in 2019. Really looking for between now and then for more of our corporate travel to come back, particularly in the CBDs, in the central business districts, and also to see our large scale convention demand come back. So we're having our bigger cities lag in the recovery a bit, and some of our other smaller markets, tertiary markets, and secondary markets have already either reached recovery or they're well on their way. So we have a bit of a mixed bag here in the US, but looking to be back by the fall of 2023, and then see that full recovery for the calendar year by 2024 overall. Here you'll see the trend in sale prices, and in that red line, the not as much volatility in the limited service sector. Similarly, with the select service sector, where that volatility comes in is in the full service sector. We've seen some positive movement on resort properties and properties less impacted by the pandemic. However, we might see that blue line dip back down as some of the urban properties perhaps trade hands next year, and as transaction activity comes back next year in fuller force. On our next slide, you'll see that we had a very strong Q2 with a portfolio transaction or two that really spiked up activity in transactions. And coming back a little bit to normal in Q3, we're looking forward to a very active 2022 in the US. Like I said, with properties coming out of the this year and the protections that they had with PPP money from the government, and starting now to kind of face reality of having to move forward. And on our next slide, you'll see that this anticipated increase in transaction activity next year will be fueled by some greater availability of financing. Right now in the market, the most predominant LTV, loan to value ratio, is 65%. And you'll see that there's a little bit more financing available for the smaller transactions, and then for the much bigger transactions, 100 million plus. Some financing is still a little bit hard to find. The more well capitalized you are, certainly the more easy time you'll have in finding financing. On our next slide, you'll see that the pricing is still off about 1 to 10% of value. We are seeing some assets that have fully recovered in value. Like I said, in those tertiary markets, some of the secondary markets, very popular with the limited service and select service sector, particularly extended stay. And so that is a very positive value story, whereas some of our urban properties are still seeing that impact. And so their value declines are going to be a little bit more on the negative side. You'll see in the blue bars, we still haven't seen that full RevPAR recovery. So even though our cap rates and our discount rates are back to normal, when you apply those to still some difficult NOI levels, you're bound to have that value decline. And so we're still seeing that here in the US, but we're seeing the trend towards positive. And certainly in a couple of years, we'll be back fully, hopefully, ideally fully in that positive category. Moving on to Canada, just briefly, note that the similar decline cycle, but a little bit more harder hit. The closure of the US border did not help, and thankfully that's back open, and the recovery there is accelerating, but you'll see a greater decline there with that loss, 62% in Canada versus 48% in the US. And on the next slide, you'll see that their recovery is pushed a year later, whereas in the US, we're at 2024 full recovery, we're looking at 2025, mainly due to ADR lagging in the recovery just a little bit. Some positive notes for Canada: 83% of the population there is fully vaccinated, and the new supply of rooms coming in, 24,000 in the pipeline, should be open by 2025, showing significant investor interest in the country. And that's a great thing to see. And then finally, moving on to Latin America, and we'll just stay on this. You can stay on that slide for a moment. The region is extensive, not easy to paint a broad brush across Latin America, like maybe we can a little bit more in the US and Canada. Countries from a few hundred thousand to 200 million inhabitants. So they're each really dependent on their drivers. Some could be more commodity focused, some more industrialized. So our Latin America practice has to really look at each country. Each country has also handled the pandemic differently with vaccinations and policy, and that's affected things. But we'll take a more careful look here at Mexico on the next slide and note that their recovery in the business markets is taking a little bit longer to get back to normal, not surprisingly, with the same factors of people needing to be out and traveling again, businesses needing to be back in their office spaces, which our Latin America practice does expect to happen, but a little bit more towards 2025. And then finally, the leisure markets in Mexico just bouncing back much more strongly as folks hit the beaches, and the travel between the US and Mexico remains fairly robust. And that's it from my end. Thank you very much.
I'm sure Jens will be with us in a second.
Can I ask the host, please, to start the video? Thank you. On Asia Pacific, hello from the executive search team. Very nice to be part of this panel today. So in the decade before the COVID-19 pandemic hit, Asia Pacific regions experienced some of the highest economic growth rates in the world. The transformation was driven by a number of factors, and including the trade and greater integration into global and regional value chains. The Asia Pacific region has been hit very hard, especially with the continued travel bans and mobility restrictions, which greatly affect the region until today. And tourism plays a very important part to that, with the contribution to the local economies. No country in this large region was spared in this crisis. However, some of the hardest hit were those that were impacted doubly by the collapse of tourism, coupled with the disruption of the manufacturing supply chain, such as Malaysia, Philippines, and Thailand. On the next slide, we can see the contribution of tourism as a percentage of revenue to the GDP. And we can see here, top three are Macau, Maldives, and Georgia. This was 2019, just before the start of the pandemic. The other areas here that are very, very much dependent on this are Thailand, for example, Cambodia. And for China, this also makes up a very large percentage. Up to 10% of GDP in China is dependent on tourism pre-pandemic. In terms of workforce, about 28 million people in China alone are working in the tourism sector. Directly and indirectly, it's about 80 million people. So what has really impacted talents the most? On the next slide, we can see that actually the unemployment rate has not really changed that drastically in this region. Most affected were countries in the South Asia region. According to the latest forecasts from the International Labour Organization, it is looking to rebound again quite strongly in 2022. So whilst Asia was hit, it was not a total disaster, with a lot of governments having provided substantial subsidies and benefits to their people. On the next slide, we can see how talent's priorities have been affected. And I think if there's one thing that you take away from this part of the presentation, it should be this part here, where we would like to emphasize really the great importance of how the priorities for people have shifted. and we have seen a dramatic impact on work-life balance. It is very important for individuals to be able to take time off and to spend time with their friends and loved ones. So flexibility and agility for the work arrangements are key to success, and I cannot overemphasize this. If your organization has not yet had taken a very good hard look at the rule book of work, then the time is ripe to do it right now. And we can see here that work-life balance ranks very highly. And we continue to engage with individuals, and this continues to be part of many conversations that we have. People are really needing to have a very sensible approach to this and being able to have some time away. So in some cases, hybrid arrangements have been put in place, and that we see that that works quite well. On the next slide here, we can sum up some of the key trends. So leadership hiring has been very subdued due to the travel restrictions, but it is now accelerating, and we are seeing an uptick in demand. Payroll was always the #1 expense driver for our industry, and it has become a much more variable expense over time, and hybrid work arrangements are part of that. Substantial restructuring has taken place within many organizations. No one was really spared, both corporate level and field level. Health and safety comes first now, whereas guest first is now health and safety first. Additional expenses come with that as well. 2021 has shown a noticeable uptick in demand, and we have been engaged in several placements and projects very recently and continue to be. So the trend is very positive as the year has progressed. And we are very confident that 2022 will hold a much better recovery for this region as we move into the last part of Q4 of 2021. Thank you again from the executive search team. That is it from my side, and back to you, Russell. Thank you.
Thank you so much. I think that we've done very well so far to keep to our time, or at least to an approximation of our timing. And I'd like to invite all our presenters to rejoin me on screen, and we'll then move into our Q&A. And I'm pleased that we've had a couple of questions that have come in from members of our distinguished audience, and I'll try to get those. Do let me have your contributions. Do let me have your questions. And I'll look forward to being able to handle them in the course of the next 20 to 30 minutes. I'm going to kick off. I know it seems a long time ago that Hock was presenting on Asia Pacific, but given that this is your region, and others can chime in if you so wish. Hock, what's the HVS take on the recovery of business travel in your region? And how do you think business hotels can reinvent themselves, reinvent their business model in anticipation that things like virtual meetings such as this are going to be part of the new normal?
I think the view that we've taken is that business travel will definitely come back, although a bit slower perhaps than leisure, and also depends on the restrictions for each respective country in Asia Pacific. Some countries in Asia Pacific are actually very stringent. They want to have 0 COVID cases, so they're not opening up. Some are more open, and some may have vaccinated travel lanes. So in relation to business, right, I think, and especially we have been, doing all these Zoom meetings and what have you for the last 18 months or so. Many of us are accustomed to that, but when we speak to the people on the ground and when we speak to each other, right, people want that face-to-face connection, the ability to kind of look at you and not just virtual like this, right, flat on the screen. And you will find that especially in countries, let's say in Australia or China, people are really returning to business meetings. And the convention centers are actually having a fair bit of business. And also even for Singapore, we are opening up to having some of these meetings, and we have a Bloomberg meeting that is coming up next month, where we will even allow the delegates to dine together. Although at the current moment our dine-in is restricted to 2 persons, but just for the Bloomberg activity, it will be for 5 persons to be able to dine, because the feedback that they get is that people travel from far away, from wherever, to come together, and their businesses, and they want to get to know each other, reconnect, and what better than to over a meal outside of the meeting. So
one of our, I'm going to interrupt you there. One
Yes.
of our distinguished audience has picked up on this, and I wondered if there's any region in the world where there is expected to be a rather more permanent dent in the conference and meeting sector, perhaps as a result of virtual meetings being insisted upon by corporations and businesses alike. Anywhere in the world where there is likely to be a restructuring of the convention business? In which case, thank you, Mr. T, for your question, but it looks like there isn't. Let me invite any of the other members of our panel. Rod, you're obviously ahead of the curve from anywhere in the world. The convention business seems to have bounced back with a passion. And from what we've been hearing already today from your good self, it sounds like the US, North American business anyway, is really back with a vengeance and, as you would say, going gangbusters. Is that conclusion fair?
No, I'll clarify that for our tertiary markets, our highway markets, things are back with gusto. However, our center cities, some of our northern convention markets are still very much under a cloud of impact, and we need these markets to open back up. We need travel to return. And that's what's really going to hold back our recovery over the next couple of years. We do see that business, it will come back. People love going to these cities and love visiting them, and convention business will return in a robust fashion. But we are a couple years away from being back to that point.
Okay, an open question for anybody. Has there been any change in the kind of buyers in recent times, and as a fallout of that, the change in valuation? Our delegate seems that buyers continue to focus on more distress opportunities than pay a fair price currently. Is that your experience, Charles?
I'd say there are a lot of frustrated buyers right now. I've never seen such a gap between weight of capital and product to buy. Pretty much all of it in the value add space, looking to seize on opportunities. And so far, at least in Europe, I think this is the same in the rest of the world, we've seen virtually no kind of true distress, and I don't think that's going to happen. So I would say buyers so far that we've seen here are experienced European-based buyers who are taking a long-term view, see value, are not unrealistic in their expectations. I think we're seeing competitive bidding pushing up pricing. So yeah, a lot of buyers are, I think, undervaluing unrealistically.
Hock, what do you think the reason is for there being only limited transaction activity within the Middle East region in the past 18 months or so?
I think that would be Hala, Middle East.
Sorry, I did mean Hala. I'm sorry. Too many
problem. Actually, I wanted to add to the point that Charles made with regards to frustrated buyers, because we're seeing clearly the same. I mean, Dubai continues to be a very attractive market for investment purposes, and elsewhere in the region. And, this is what I was trying to hint at earlier on. Clearly, there were some distressed assets What I have personally observed is that we don't have distressed owners in our part of the world, and that's probably because of the ownership structure. So while at the property level, the performance is bleeding and they're having to put their hands in their pocket to support the operation, the type of ownership being predominantly government entities, they are not necessarily willing to discount, and those buyers are looking for distressed assets. So there aren't really distressed assets as per se in the sense of ownership. What is also interesting and has always been the challenge in this part of the world is the overspending when developing these assets. So even the fair market value, our sellers or our clients are challenging us, because when they compare it to the actual development cost or their book value, there is a disconnect there. And this is likely to continue in the foreseeable future, which means we're gonna not necessarily see major transactions taking place unless there is a management of expectations on both selling price, especially as we now look also to recovery, but not necessarily so much of improved EBITDA levels. So the values in the GCC specifically are pretty much to stay where they are at the moment.
Okay, I'm going to move on to another question. I'm going to guess this is a gentleman from India, and I'm going to ask Mandeep to consider an answer anyway. Is this a good time to look at fractional ownership by smaller retail investors as a serious method of funding or transacting on hotel assets? Mandeep, do you want to kick off an answer on that?
Sorry, yeah. I don't think the time has come for fractional ownership in India yet. I think even the laws, there are issues on how fractional ownership can work in the legal framework. So I think fractional ownership is still a little while away. The market is not ready for that, although I know that there have been some attempts in the past to look at it. But it will need a little more time and some correction in the laws on owning property in fractional fashions before we can really get ready for fractional ownership in India.
Okay, I'm just going to move the questions to Jens for a moment. In regard to work-life balance for associates, how do you rate owners and investors' awareness that this might be key to be addressed to remain competitive in the talent marketplace?
Great question. I think that there is a very much growing awareness in the region about this, and we have just today had another announcement of a major player in the market who has shared that they will have a much more flexible approach to working as part of their organization. Again, a hybrid arrangement that was announced today. So it is something that ranks very highly for international organizations. However, other smaller local players still have some catching up to do, and this is where we can assist, and we have been assisting in our conversations very much.
Okay, moving back to the Southeast Asian region, what is the expert view? It's wonderful that we've got so many experts on the call at the same time, including members of our delegate panel. So what is the expert view on what will happen to distressed assets in ASEAN? Will they be converted to other kinds of assets? And if so, what kind? Hock.
It's really difficult to talk about distressed assets in Asia because many of them are held by high net worth individuals, family trusts and funds. But we have seen in the recent months that there has been some conversion of, I would say, hotel assets to co-living space. And I think particularly we find that in Hong Kong. Jans can correct me if I'm out of line there, but I think there has been a number of conversions of hotel assets, probably in the mid-scale or upscale products into co-living spaces. So people are spending money to upgrade them to co-living spaces, to have a communal space, and also to probably take a longer term view because the stay could be, from instead of daily to weeks to months. and also more flexible as compared to perhaps getting a rental on any apartment. So we do see some of that, and also in Singapore we see a number of co-living players that have come into the market in the recent years. That seems to be the trend.
Thank you. Mandeep, do you have anything to add to that? And whilst you're considering that, one of our delegates wants to know, where are the bargain buys in Asia? I think we'd all like to know that.
Hawk, are you going to talk about Asia, or would you like me to first finish what?
No, you go ahead.
You go ahead first.
Yeah, okay. I think there is certain amount of consideration of change of use for hotels. I think it's happening across the globe. I think Hawk covered it well. I think we're seeing some movement into co-living spaces, into student hostels. We're also seeing, we're actually doing one transaction, which is right now in due diligence of a hotel being converted into a hospital. So we are seeing some of this. We're also seeing some usage of hotel space in ways that we haven't seen earlier, as hotels start looking at revenue per square foot, which we earlier were not so keenly looking at. We've seen a lot of e-commerce companies in India starting to look at spaces in hotels, which help them in reducing their delivery periods. So there is some talk of that happening. And we're also seeing some of the reuse of space in India, where F&B outlets are being outsourced to private players. So there is some rethinking on the way hotel spaces can be used, and it's creative, it's interesting, and we are working on some of these projects.
Wonderful. Rod, I'm going to pick on you again, if you don't mind. I just wonder if there are US investors that you're in contact with who are keen to invest in the Southeast Asia region or South Asia, India, and so forth. Is there a demand from the US investment community to put their capital into the Asia Pacific region?
There is, however, the inflow of capital tends to go in the other direction, with more investors from Asia looking to the US for assets and opportunities.
Okay, thanks for that. One of our delegates is asking, will the global corporates come out stronger, or do we see growth in owner-operated ventures? Anyone want to pick up on that one? Just hold your hand and fire away. Are the global corporates going to come out stronger, or do we see a growth in owner-operated ventures? Hala, what do you think?
I'm trying to understand the question. If we're talking about global operators, what is meant by global corporates? Because we are.
I think they mean the big owner-operated brands, the Hiltons and Marriotts of this world.
Right. So we're interestingly seeing in the last 24 months, but more so now, that relationship is changing in our part of the world, where traditionally it was more about the larger corporation management contracts. And we are seeing much more homegrown brands, but also white label operators with franchise model, which is very uncommon to this part of the world. So clearly in the Middle East and Africa, we're seeing some change there in the way these international operators are operating in our part of the world, and specifically in Africa, where they are predominantly giving out franchise to operate assets.
Any noticeable change from your perspective, Hawk?
No, actually, I think HMA seems to be still very predominant in this part of Asia Pacific. Franchise models probably in only limited markets that seems to be going for that, and also certain brands. I would think that coming to that question about the corporate, will the corporate fare better? I think in the long run, as a corporate is very robust, right, and has gone through so many cycles of, different type of crisis. They should be able to come out of, any situation better. And for the owner, the individual, probably they can pick up and they can, gain some inroads into this area. But it will be a very steep learning curve, I think.
Okay.
I think, can I add from Europe?
Yes, sure.
I think what we're seeing and likely to see a continuation of is that because the markets become more leisure focused, and I think that trend will continue. There is travelers will like the experience, particularly with the internet and the whole search for hotels process, which is all part of the fun. They'd like to find new niche products. And so I think we're going to see an increasing trend towards the boutique segment, independence, and hence why the big brands are having to expand their portfolios into away from the more mainstream brands to more niche products. And I think I don't see any change in the ownership of hotels. I think the brands are out of that, and the sort of bricks and the brains are split forever, in my view. But I do think we're going to see an increasing trend towards more niche products, brands, naming, independence, that type of scenario.
And just back to HOP for a second, will the third-party operators of branded hotels start to be more prominent within Asia?
I think certainly there is room for them to grow, and but again, in Asia Pacific, it's still the brands that is coming up more, with a number of independent boutique offerings.
Okay, I'm very conscious that we're getting well past the time when we promised our audience that they could be back at their desks or in some parts of the world at their lunch table, or indeed on their way to their beds. So I'm regrettably going to ask you all one final question, which I would appreciate a very short, one sentence, one breath answer, which means that it has to be short, otherwise we'll start describing you as the Harry Houdini of HVS. So here's the question. Based on your own experience and given everything we've discussed in today's webinar, what is the single piece of advice that you would like to share with our delegates as to the best way to improve their hotel's value over the next 6 to 12 months? So you all understand the question. I want one piece of advice. And the bad news is the later you are in the cycle, the more chance there is that someone will have stolen your answer. So I'm going to allow ladies first, simply because I'm a chauvinist pig. And I will ask, if you don't mind, Hop to kick us off with an answer, followed by Hala, followed by Mandeep, followed by Rod, followed by Jens, and then Charles. Okay? Hop, kick us off. One single piece, one breath.
A long breath, but I think it has to do with manpower. You need to review your manpower needs in order to stay above the line.
Okay, Hala?
I'll say focus more on Jaipur. They have been quite successful in reducing costs. They shouldn't overcharge and overspend.
By Jaipur, you mean gross operating profit per available room?
That's right, right. Because the focus now is on increasing RevPAR, and it's important to maintain those cost efficiencies.
Okay, focus on the top line, but don't forget the bottom line. Mandeep.
Time to get serious about ancillary revenue and revenue per square foot.
Wonderful, man after my own heart. Who's next? Was it Rod or Jens? I forgot.
I'll go. I'll just say, let's not forget that we're the hospitality industry. So find new ways to motivate your employees and reward them, because that will then come back tenfold with happy guests and more revenue.
Okay, Jens.
Thank you, Rod. And adding on to that, don't wait with your hiring decisions until the last moment. It takes time to find people, and there's a real war for talent going on in some parts of the world already. So it's coming to Asia Pacific and Europe as well. So it takes, please plan ahead and strategize on it now,
Thank you. Charles, the last word from you.
This is a comment more to do with value on exit rather than profitability along the way. And my advice would be to leave something in the tank in terms of value add opportunity for the next buyer. Buyers are increasingly looking for a story, and that's why they're buying hotels. And so leave a little bit of a story in the hotel rather than completely squeezing it dry.
Wonderful. Ladies and gentlemen of the panel, thank you so much. And to our esteemed delegates, it's been a pleasure for us to present this to you. I'm going to invite Chris Shepherdson to come back to the microphone and to give us his main learning points, and then to welcome Stephen Rushmore, the president of HVS, president and CEO, to wrap things up. But for the moment, panel, thank you all very much indeed.
And thank you, Russell, and thank you to all the speakers. That was the most fascinating session. It really was. And I think there's all kinds of learnings coming out of it. I thought, Charles, your final comment there was excellent about creating some value add, to leave value add in the business. I think that's really interesting. I also think a bit about boutique hotels, again, to build boutique services is also fascinating too. I actually found all the information we went through about which regions are outperforming or coming back strongly, which ones are struggling a little bit more. Really interesting because there's so many different regional pieces going on there. It is quite a complex picture to understand. However, I think the overall message is that looks like we're on the road to recovery, which is good news. And that obviously recovery is about 2023, 2024 overall, which is still, we know it's going to be a long journey. We know it's going to be difficult, but at least we're on that road now. Now to invite Stephen to join us. And Stephen Rushmore, the President and Chief Exec of HVS, to make some closing comments. Stephen, can I ask you to come onto video?
Hey, hello there. Hello, everyone. Thank you, Chris. And thank you, everyone at HVS who have made this event possible. And thank you to all of you who have attended this webinar today and your excellent questions, which has really driven much of the content that we just shared. We will be making these slides available to you afterwards, and I'd encourage you to follow up with any of my colleagues should you have additional questions. And that's it for me. Thank you. Take care, be well, and stay safe.